Good day, ladies and gentlemen. Welcome to Financial Management 2 class. We are still working on current asset management, still under account receivables management. Last week we did an average collection period where we get to find out how long will it take for our customers to pay back, how long will it take for us to collect all our cash from the credit sales we made. So today we will continue from what credit standards. Credit standard. you know, when we relax our credit standard, are we going to benefit from the relaxation? Before that, what is relaxation? Relaxation is when you change or increase the number of days where customers can pay back all your cash. For example, this is our credit standard. If you can remember last week, A to B net C, which means if you pay, for example, within 10 days, you are entitled to get 5% discount. Otherwise, you pay all the amount in 30 days. So this is your first standard. So this is your second standard, which is being relaxed. What is the difference? Is what the net day is 30, and here the net day is 40. So you have relaxed what 10 more days. That means you have given customers additional 10 days, which is from 30 to 40 days for customers to pay back. So this will what increase in their number of account receivables. Yes, of course, your credit sales will be much. The sales volume will go up, as well as you will make more profit. So the disadvantage is that you will have increase in bad debt. Your bad debt will increase. Just for instance, if now you 1010 decided to say, okay, all lame cooking student can buy stuff there for the whole semester, goods worth amount of 1000 ringgit. So at the end of the semester, you pay. So you will see that the sales level of 1010 will go up every semester. It will go up, and the bad debt will continue to increase. So those are what the differences. So we want to find out if we are to relax our credit standard or not. So here is a question that I have written down. Zenith Bahad current annual sales is 9.6 million. Annual sales are on credit in 2019 with a contribution margin of 17%. Zenith is deciding whether to relax its credit standard, which will increase sales to what 12 million and increase average collection period from 3 months to 4 months, and increase bad debt from 1% to 3% of credit sales. Zenith Bahad opportunity cost of tying up funds in each account receivable is 12%. The question is, should this company relax its credit standard? And if it is so, why? In this situation, we have steps to follow. We have 3 steps. The first one is to estimate change in profit from sales. And second step is to calculate the cost of additional bad debt and investment in account receivables. And lastly, the difference, combined difference, the first step minus the second step, which will give us the third step. Okay, before we proceed to the steps, we have to summarize this information in a table to what reaffirm that we understood the question. Yeah, okay, this is the table. Anyway, this is my second video of the same topic. The first one I made is I was writing and as well as explaining, and it takes so much time, so I decided to just explain again without writing, which will lessen the time you will watch the video. Okay, so I have transferred this information into this table format. This is the entire question. So this is the current policy and this is the proposed policy. The current policy annual sales is 9.6 million. The proposed policy, which is if we relax our credit standard, it will increase to what 12 million. Contribution margin 7%, all 7%, 17% rather. Bad debt will increase from 1% to 3%, and collection period, our credit standard period is 3 months, now increased to what 4 months, and our required return is 12 months and 12 months the same. So okay, this contribution margin, I mean to explain the contribution margin, 17% and 17% is already given to us from the question here. But in some questions, this contribution margin will not be given to us. Otherwise, they will provide variable cost. So how do you get contribution margin? It's sales minus variable cost. So you have to minus the sales from the variable cost, and you can get the contribution margin, the amount, not even in percentage. Okay, so this is already given to us, so no need to worry. Now let's go to our steps. Step 1, estimate change in profit from sales. What are the changes in profit from increase in sales? So the increase in profit, our first amount is 12 million minus 9 million. So what is the difference? 12 million minus 9.6 million, which will give us 2,400,000 ringgit. Okay, that is our increase. So how do we get our increase in contribution? Remember, our contribution margin is 17%. So our contribution is what? 2 million. This increase amount multiplied by 17% gives us 408,000 ringgit, which is the increase in contribution margin. So we go over to bad debt. Our bad debt increased from 1% to 3%. So we start from 3%. So this is new. Okay, new bad debt is 12 million multiplied by 3%. 12 million multiplied by 3%, which gives us 360,000 ringgit. Old bad debt, 9.6 million multiplied by 1%. So 96 million multiplied by 1% gives us 96,000 ringgit. So what is the difference? Less increase in bad debt. What is our increment? So 360 minus 96 will give us 264,000 ringgit. So what is our net total? Our net is, we have to remove contribution margin minus what? Our increase in bad debt, which is 408,000. This amount, we have to bring this amount here minus what? This increase in bad debt, 264,000. Total will give us 144,000 ringgit. So that is our net benefit. Not net benefit yet. That is our increase in profit from relaxing our credit standard, 144,000 ringgit. Okay, now we move to step 2. Step 2 is to estimate the cost relating to increase in debtors. Estimate the cost relating to increase in debtors and inventory. So the new level of debtors is 12 million, right? Our new level of credit sales, yeah, those are our debtors, definitely. So 12 million multiplied by 4 divided by 12. How did we get 4 and 12? 4 is what? Now the new month of collection, the collection period, which is 4. And this is 12, our credit sales. 4 multiplied by 4 divided by 12. Why 12? It is 12 because it's the what? Number of months in a year. Okay, number of months in a year. If we say, let's say 3 months, 90 days, or 2 months, 60 days, then we'll put the 60 days divided by what? 360, number of days in a year. So now we are using months, so we use the 12 months. So 4 divided by 12, this amount will give us 4 million ringgit. Then we go over to the old sales, which is 9.6 million times 3. 9.6 million multiplied by 3 divided by 12. Okay, gives us 2,400,000. All right. Okay, so now what is the difference? We have to minus this. 4 million minus 2.4 million. 2.4 million gives us what? 1.6 million, which is the increase in debtors. These are the increase in our debtors account. So when we relaxed our account receivables, we found out that we what? Increased our debtors by 1.6 million ringgit. Okay, So what is our total cost of investment? Investment cost is what? This amount, 1.6 million multiplied by 12. Where do we get this 12%? Sorry, this is not just 12, it's 12%. So let me just write the 12% or 0.12. 12%. Where the 12% come about? This is our required return. Okay. The opportunity cost of this investment. Investing in additional sales. So this will give us 192,000 ringgit. This is our cost. You see, we have gotten step A, step 1 and step 2. So the step 3 is very easy. Step 3 is very easy. So step 3 is what? Step 1 minus step 2. So step 1, our net increase in profit is 144, right? Total here is 144. And this is 144, and our investment cost, which is the step 2 investment cost here, 192. Here we brought it 192. So if you minus these two, 144 minus 192, always use the first two minus the second, it will give you negative 48. Negative 48. It's supposed to be positive amount, but it's not giving us negative. Well, that is not usually what the business wants, but it's okay. It's our estimation. So as a finance manager or analyst, what is your decision? Are you going to recommend for them to relax or not? So here, obviously not recommended, since our cost is 48,000 ringgit. Instead of making profit, we are making a loss. So it is not recommended for this company to relax its credit standard. They should leave it the way it is. All right. I hope you understand this. Yes, this video will take much less time. The first one, when I was typing and also explaining, it takes about 30 to 35 minutes. I think this one is doable. So I have an exercise here for you to do. It's also very easy. Just follow the steps I just explained. If you can understand, you repeat the video. If you are still having trouble in understanding, you write a comment in the group. I will respond as soon as possible. So Birang Bahad is currently selling its product for 50 ringgit per unit. All sales are on credit. In 2018, 20,000 units were sold. Variable cost per unit is 20 ringgit. So you see, this is variable cost, not contribution margin. So you have to find the contribution margin by minusing these two. 50 minus 20, this is for unit, but you have to do it for all the products. So definitely, if you want to get in total 50 multiplied by 20, 20 multiplied by 20,000, then the difference is you minus from the first and the second, then you have your contribution margin. So Birang Bahad is deciding whether to relax its credit standards, which will increase unit sales by 5%. Unit sales will increase by 5%. Increase average collection period from 25 days to 30 days. And what? Increase bad debt from 3% to 6% of credit sales. Birang Bahad opportunity cost of tying up funds in each account receivables is 6%. So required. Calculate the additional profit from the increase in sales. Calculate the cost of additional investment in account receivables, okay, which is the second part. And within the second part, we also have calculate the cost of additional bad debt. Then finally, you do the combined effect, which will give you should the company relax its credit standard and why. So these are typically the same thing we just did. So you practice this question, and hope to see you again. Yeah, we have another one, which is, this is relaxation, right? We have tightening. So you have to tighten your credit standard. Tightening is when, instead of increasing the number of days, for example, if it was 30 days for customers to pay back, then you tighten, you reduce to what, 20 days or 25 days. Okay, if you do that, definitely it will reduce your sales volume. Customers will not be coming to buy because your credit period is too little. But definitely you will be cash rich because all customers coming to buy, they pay on time, they pay within the time limit. Therefore, you will make some more money, more cash, but less customers to buy your product. So there are also other effects. So that's what we are going to do in the next video. You just watch this. Thank you.